A financial advisor was denied by Wells Fargo because her tax return showed no income. Now, using bank statements instead, we qualified her for $60,000 a month in income and a $3 million home purchase. I'm Benny Rabishan, and today I'm breaking down exactly how bank statement loans work, the product that can triple your qualifying income without changing your tax strategy. If you're a business owner who writes off expenses strategically, your tax returns probably show minimal income or even losses. But your bank statements tell a completely different story. They show the real cash flow of your successful business. Traditional lenders only look at tax returns. Bank statement lenders look at actual business performance. So a bank statement loan uses 12 months of your personal or business bank statements to calculate qualifying income instead of tax returns. We analyze your actual deposits to determine how much you can afford, not what you reported to the IRS. This works for everyone from gig workers to corporation owners. Any business structure can benefit from this approach. The first option uses your personal bank statements from the last 12 months. This works best when you have clear business-related deposits coming into your personal account. This is perfect for hairstylists, consultants, or service providers who maybe receive Venmo, Zelle, or direct payments from clients. We can clearly identify business deposits versus personal transactions. So here's the calculation. We take 100% of verified business-related deposits over 12 months, and we divide by 12 to get monthly qualifying income. Now, the challenge is commingling. If your business and personal expenses are mixed together, it becomes harder to isolate true business income. The second option uses business bank statements, which is usually cleaner because there's no commingling. Here's the calculation process. First, we add up all qualifying deposits over 12 months. We exclude transfers between your own accounts and any abnormal one-time deposits. Only legitimate business revenue counts. Then we apply an expense ratio, typically 50%, to account for business operating costs. Example, $200,000 in deposits over 12 months minus 50% expense ratio equals $100,000. Divide that by 12 months, $8,333 a month in qualifying income. But here's the game changer. If you run a lean business, work from home, no employees, minimal overhead, we can get a CPA letter stating your actual expense ratio. The lowest we can go is 15%. Same 200,000 with 15% expense ratio, 170 grand divided by 12 equals 14,166 a month in qualifying income. It's almost double. If you have business partners, we factor in your ownership percentage based on operating agreements or CPA verification. All right, let me share that financial advisor case. So she and her partner ran a successful firm, but their tax strategy showed virtually no personal income. Everything was written off. Wells Fargo said no income, no loan. We analyzed her business bank statements instead. Now, after applying the 50% expense ratio and her 50% ownership stake, we calculated $60,000 a month in qualifying income, approved her for a $3 million home. Another example, a gig worker doing ride share and delivery services. His Schedule C showed $28,000 after writing off vehicle expenses, supplies, and phone costs. But his personal bank statement showed $85,000 in platform deposits over 12 months. We qualified him for $7,083 in monthly income, more than double his tax return income. Third example, corporation owner in retail. Businesses showed losses on their tax returns due to inventory write-offs and depreciation. Business bank statements revealed $1.2 million in annual deposits. Even with a 50% expense ratio and his 60% ownership, we calculated $30,000 a month in income. So here's what makes this brilliant. Accountants love recommending bank statement loans to their business owner clients because it lets them be the hero twice. First, they execute aggressive but legal tax strategies that save clients thousands in IRS payments. Then those same clients can qualify for a real estate purchase that will appreciate over time and provide additional tax benefits through homeownership. Your accountant gets to write everything off for maximum tax savings while you still get to be approved for a home you want. It's a win-win strategy that works with your financial planning, not against it. To qualify, you need a minimum of 18 months of business ownership and at least a 680 credit score. score. For lower down payments, 10% down requires 720, 15% down requires a 700 score. Let's talk costs. These are 30-year fixed mortgages for the most part, but expect rates about 1/4 to 0.5% higher than conventional loans. You'll also pay 1 to 2 points in closing costs because this is such a niche product. Here's the math. Paying an extra 0.5% in rate and 2 points up front versus claiming $50,000 more in income on your taxes. That extra income could cost you $15,000 or more in annual taxes. The loan costs are typically much less than the tax savings you preserve. If you're a business owner who's been told your income isn't sufficient for the home you want, bank statement loans might be your solution. I've created a detailed bank statement loan guide that breaks down qualification requirements, calculation methods, and includes more case studies like the ones I shared today. To get immediate access, comment statements below and I'll send you the playbook directly. Ready to see what you actually qualify for? Book your free 20-minute discovery call where we analyze your specific situation and determine if bank statement lending makes sense for your goals. Link is in description below. I'm Benny Rabishin, and I specialize in creative financing that works with your business strategy, not against it. If this opened your eyes to new possibilities, subscribe for more insider mortgage strategies designed specifically for business owners. Your business success shouldn't be hidden by smart tax planning. The right lender knows how to see and leverage your actual financial strength.